Hey everyone, Richard Norris here, and in this video today I want to share with you what is the best area to invest in across the UK. Now, for those of you who are new to my channel, my name is Richard Norris. I've successfully built a multi-million pound property portfolio, and my group of property companies currently does over 200k a month. Now, with all of this being said, right now, like I'm sat in Dubai, I live in the St. Regis residences, and it's quite ironic when I'm shooting this video sat in the St. Regis residences. And why am I making relation to that? The reason I'm making relation to that is because St. Regis, for those of you who know it, they're basically like behind the scenes of the hotel. They basically brand themselves that they have the world's best addresses. So all of their St. Regis resorts are based around the best areas in the world. They've got the best postcode, the best locations. And right now I'm sat in the St. Regis Hotel on the Palm, which is where I live. And in the background there, you'll probably be able to see the Atlantis residences. Again, prime location, key real estate, which is why I find it ironic that I'm shooting the video today from where I am, and we're going to be talking about where best to invest. Now, with all of that being said, again, if you're new to my channel, please make sure that you go and like this video. Please make sure you go and subscribe. Hit that bell icon so that you can be notified of any new content that I release weekly. So let's jump in. Like, how do you find the best area to invest in across the UK? And the first thing that I really want to discuss with you is, like, we have an acronym, and the acronym that we use is Strategy Area Property, right? So what is the strategy that you're looking to deploy? This is the most important part of finding your area, right? And so it really does depend on your personal individual circumstances and the goals that you have. But let's focus on strategy. So are you looking to do buy to let? Are you looking to do HMO? Are you looking to do serviced accommodation? Are you looking to do commercial conversions? Or are you looking to do commercial property? Whatever strategy that you're looking to deploy will honestly depend on the area where you choose to invest. Now, when I say the area that you choose to invest, you might like take Oxford as an example. That's where I'm originally from. So let's take Oxford as an area, right? And you might say, well, in order to do commercial property or commercial conversions, they might work best in OX1. And then maybe if you're going to do buy to let, two-bed properties, two-bed terrace, three-bed terrace properties, where you can get properties for cheaper, maybe you'll go into a location like OX26, which is like Bicester, for example. So when you're looking at an area, you really have to distill it into postcodes based on the strategy that you're looking to invest in, rather than the whole town as well. So, like, the number one thing you need to think about is, like, what is the strategy, and then what is the goals that you have, right? Are you looking to achieve capital growth, or are you looking to achieve cash flow and grow the portfolio as fast as you can? Because let's say you're looking for a high growth strategy, so you're just investing for capital growth and you're not worried about cash flow. Therefore, you might just be putting down 25% deposits, taking out 75% mortgages, or maybe you're just investing for cash and all you're investing for is for the capital growth. And the reason that you want to invest for capital growth is because maybe you have a really good income, you're a business owner, or you earn a lot of income from employment, right? Maybe you're a six-figure high salaried employee and you get paid a lot of money, and therefore property is something that you're doing on the side, and you're looking for that like additional income or a safe haven to park your cash, right? So if that were your situation, then you're more likely to go to areas like Oxford, London, like the southeast of the UK, where you're going to be able to achieve higher capital growth, prime location real estate, and you're going to expect to get a much lower return on your investment. Now, with areas like that, when you're doing, like, say, for example, a buy-to-let strategy, if you're going to Oxford, like right now with current interest rates, and let's assume that you're leveraging debt, so you're taking out mortgages, you're going to have to put down a bigger deposit. So maybe you're putting down like a 40% deposit in order to meet the rent affordability criteria across the UK right now, based on the current climate that we're in, which is at the time of shooting this video in January 23. So, like, that's a big factor, right, and a big consideration, because if you don't want to put down 40% deposit and you don't want to tie up too much cash early on, then Oxford's not going to be the place for you, as an example. So it does depend on the goals that you have. What are you investing for? Capital growth or cash flow, or a mixture of both? And, like, how much cash do you have to start and grow the portfolio? So, for example, if you're like the investor like I just sort of described there, maybe you're the avatar that has 500,000 plus £1 million of cash reserves. You want to go and buy in prime locations. Like, you'll find that high net worth individuals deploy that strategy. They tend to do less buy refurbishment refinance, and if they've got other incomes as well, they'll definitely want to be hands off with their investments, and they'll basically buy prime real estate in prime locations with great addresses, for example, like the St. Regis do, and they'll hedge their bets against long-term capital growth, right? And it's a better place to park their money than in the bank. So in that scenario, like, those areas are going to work where there's a low yield for that type of investor. But let's say you're looking for a buy-to-let portfolio and you're looking to build the portfolio, but the number one thing that you're looking for is you're looking for cash flow, right? And you want to get the highest return possible. So the return on investment might be, say, you want to get 20% plus return, and you want to leave the least amount of money in the deal as you scale out the portfolio. So you're looking for those high yielding, high return properties. Well, you're going to have to venture out of the southeast, and you're going to have to invest more in the north of the UK, places like the northeast or the northwest of the UK, where you can basically get yields that are above 7%. Right? If you can get yields that are above 7% right now in the market with currently 5% interest rates, your cash flow is still not going to be great, but you are going to get cash flow, and you are going to leave like a small amount of money in deals if you can get 20-30% returns. You have a way better chance of doing that in the northeast and northwest if you're deploying that as a strategy for cash flow than you are going to in the southeast. So the first thing I want to say to you is it's all about the numbers, and you've got to make your decisions on data. Honestly, the biggest mistake that I see when people come and start working with me is they want to invest in the place that they live. Like, that makes the most sense, right? Because it's the data point that we have, and we make all of our decisions on data. And if we have that data, it makes us feel more secure. But then what they don't know is they don't know how the numbers work in that location. So the expectations misalign with the strategy they want to deploy. So for example, let's say, for example, I've got an investor comes to me, has £100,000 of cash, lives in, say, the southeast of the UK, and is looking to get a £10,000 net cash flow in the next 2 years off 100k of cash. Well, if he's investing in areas, or they're investing in areas which are like low yield, high capital growth areas like Oxford, which is where this person was living in this hypothetical example, the numbers actually don't work for their strategy, because they're going to buy one property, they're going to end up tying up most of their capital, and they're going to cap growth. They're only going to be able to grow every sort of 3 to 5 years when the asset's gone up and they can leverage their money again. But they're not going to be able to leverage their money or make it work as hard as somebody who deployed the buy refurbishment strategy with £100,000 in the northeast of the UK that's accepting higher yields, lower capital growth, but they're basically investing purely for the cash flow, right? And they're going to be looking in areas where the demographic and the tenant type is of a different caliber, to be honest, than the person that's investing in, say, London or the southeast, where you're investing for like the professional tenant market. And if you're getting prime location, then you're going to have affluent individuals that are going to be renting from you for that capital growth per se, or people that are in great jobs that earn good money. Whereas if you're investing in the northeast, northwest, and you're getting high yield, then the tenant demographic, they're likely to be like people that aren't earning as much money as the people that live in the southeast, basically, is my point, right? So you have to think about product market fit as well. Like, what is the demand, right? And that comes on to, like, if you're thinking of deploying like a 2 or 3 bed terrace strategy, for example, and you're looking to attract like professional people, like, you have to understand, like, where is the best location to look for product market fit, so that I know that I can rent this with complete predictability, and I know that I'm going to get the return that I want to get. Marrying up those two things, A, your product market fit, and B, the numbers, marrying up those two things is really the sweet spot. And that's the area that we're trying to find as investors. And the only way that you can really do that is to pull in the data from systems like Rightmove and stuff. Now, in my training program, Property Investors Accelerator, I have a number of spreadsheets with algorithms. I'm a bit of a geek. I've got lots of systems with mathematical algorithms built into them. And we can pull data in from Rightmove and look at the data, and it's going to tell us how the numbers work, right? Because if I'm looking to invest in an area where I want to be building an aggressive growth strategy to 10,000 net cash flow with a limited pool of funds, then I need to be investing those areas, like I said, where you're going to get the high return. Therefore, I need to find areas in the UK and postcodes where the numbers just work, where I know I can buy, add value, refinance, repeat the process, and even at 5, 6, and 7% stress test, I'm still able to leverage at 25%, hit the rent affordability, and make the profit that I want to make. So it's all about trying to find those metrics and pulling in the data to the metrics and the parameters that you define. And that's an individual thing. That's like when you find your area, it's not like a generalist thing. And I know in this video I'm talking a bit generalist, but you have to start generalist somewhere. In the program, we show you exactly how to basically double down to your specific strategy, the goals that you have, and we have different spreadsheets and different algorithms for the different strategies, so that we can really get laser focused and pull in the data for the exact strategy for the individual person's goals and unique parameters that they're setting, right? So it's all about the math, reverse engineering your goal, deciding whether you're investing for cash flow, capital growth, what the strategy is going to be. Is it buy to let, HMO, commercial to residential? What does that look like? And then finding the postcode that's right for you, right? So let's say, for example, you're looking for an HMO strategy, right? Now, there's certain things that are gonna come into your area analysis that wouldn't be necessary in a buy-to-let area, for example. So if you're looking for an HMO, sometimes if you're looking for student HMOs, professional HMOs, or even government-backed, you've got to make a decision on one of those three, right? Once you know that, you can then get defined around the parameters that you want to do. If you're looking to convert, say, C3 residential use properties, which is just what is just a normal residential property, like a three bed, two reception room property that's used to be rented to families or professional people, and you want to convert that into C4 use, which is HMO. Sometimes there's prohibitive legislation in areas like Article 4. And if you're looking to do conversions and change the use from C3 to C4, going in an area where there's Article 4, where there's planning restrictions, may not be the most ideal strategy for you right now, because Article 4 prohibits putting up new properties. Now, sometimes Article 4 says, hey, it's just a complete blanket no. If you try and put in a new application for an HMO in this postcode, in this street, we're just going to outright refuse it. So you're not going to go there in the first place if that's the strategy that you want. But if you're an investor and you're looking to invest in prime location, let's say student, a lot of student areas in the UK have great postcodes where there's great demand, so they're next to the universities and in close proximity. Those areas are usually saturated with HMOs because somebody's established there's a demand there. And because the level of HMO demand there, it means you've got great product market fit, but you may not be able to put new ones in place. So if your strategy is to take a lower return, you don't need to add any value to the property, and you just want to find assets in prime location where you're going to get a bit of capital growth, because often prime location student properties for HMO are often in your OX1 postcodes, for example, like prime central location, or they're going to be right next to the university with great transportation links and all the infrastructure around them that bolsters supply and demand. That means that house prices and growth is generally good there, right? So in that scenario, you would go in, and your strategy wouldn't be to convert, but you might buy an existing HMO property and you might put down a 25% deposit or buy it for cash, and you're happy with a lower return. And again, you're buying that long-term security that you've got a property in prime location that you know you can feel with predictability, that you'll take lower return on investment on, right? Whereas somebody who wants to do the C3 to C4 use class, and you're looking at professional tenants, and you're a new investor and you don't want to get into the whole reams of going through lots of red tape with planning to do change of use, and maybe taking the risk that it doesn't get accepted and you can't do the conversion that you want, and you're looking for the higher ROIs, then you're not going to be investing in prime student location where Article 4 is, right? And you're going to be looking for the pockets outside that are still quite close to Article 4 areas, but you're just going to pick the pockets where there's more of a ripple effect, where basically the ripple effect is that you go a central location, take OX1, again using Oxford as prime capital. So you go OX1, town center, and then the ripple effect might be OX2, OX3, OX4. In that area of 15 to 20 minutes, there might be a commuter belt, and those properties there would rent maybe well for HMOs, but to the professional market, and there's no prohibitive legislation, so you could go in and do a C3 to C4 use class change, right? But again, you're going to get lower returns in Oxford, so you'd apply the same strategy in, say, Manchester, Liverpool, Nottingham, Sheffield, but you're going to get the higher ROIs, right? So if you go out further, the further north you go, the higher ROI, and if you're doing a C3 to C4 conversion, then you're obviously going to be outside of areas where there's Article 4 to start, if that's your point of reference and that's where you're starting. So all of these factors basically is what I'm saying come into how you determine what area is right for you. And you have to establish what's the most important thing for you. Is it security, product market fit, lower returns, or is it higher numbers with a little bit of risk, leaving as little money in as possible and trying to get the best market fit possible, but accepting there may be some tenant turnover and slightly higher void periods with an HMO strategy for this example, but you're definitely going to get your higher ROI. It's more an aggressive approach. You're going to be able to build your portfolio quicker, faster. So these are the things that you need to think about, right? And also for example, I invest in the Northwest and I invest in Oxford. And in Oxford, for example, my strategy might be 2-bed apartments or 2-bed, 3-bed terrace properties where the yield's about 4 or 5%, put down a 40% deposit, getting an 8 to 10% return, but I'm buying that capital capital growth. And I might even buy like existing HMOs in prime Article 4 areas because I know that I'm going to get good growth. I know that I'm going to get very few void periods, and I'm building diversification into my model. Whereas in the northwest of the UK, for example, like I'm in Wigan, I'm in Manchester, Stockport, St Helens, Warrington, all of these places where I invest in those areas, I'm investing for that higher ROI property, right? I do commercial to residential conversions up there. I do and I do HMOs up there, right? And I'm really investing for those higher ROI. So I get higher ROI, drive my cash flow in the northwest, but then I go to the southeast where I'm originally from in Oxford, and I buy for like capital growth and predictability. And now another strategy that I deploy, and something that you need to think about with your parameters, focusing just on HMO for now, is if you're going down the government route. So who is your target tenant if you're going down the government route? You have people like Serco, you have people like Mears Group, and you have people like Ready Homes. Myself and all of my clients use these companies. So like Mears Group is for the northeast. Serco is like Northwest and Midlands, and then Ready Homes is like Southwest, for example. So you would be looking at their procurement list. Which areas in, say, the Northwest are open for procurement with Serco, right? So areas like Widden right now have been shut down. Areas like Stockport, Warrington, they're open for procurement. Serco are looking for properties and stock in those areas. So if your strategy was to buy a property as an HMO and then do a government contract with, say, Serco, Mears Group, or Ready Homes, you'd be looking at their procurement list as to where they want to invest, where they want to buy properties, and then you're going to go and buy to the demand. And you're going to balance out again, not only the product market fit of buying to the demand, but you also want to make your parameters, your ROI, what's acceptable to you. Now, if you're buying government-backed properties, for example, and you're getting a 5-year fixed lease and you don't have to worry about energy bills and all of the maintenance is taken care of by the people like the housing associations like Serco and Mears Group, and that's attractive to you, then you're not going to be buying property in prime location, right? Because often in prime location, that demographics of tenant is not going to be allowed and it won't get approved by the local authorities, right, and the local council. So in that scenario, you're buying cash flow, you're buying security, you're buying peace of mind that you've got a 5-year fixed contract, it's completely hands off. And the advantage is that you're getting probably a really good return on your money as well, like 15, 17, 20, even 25% plus on some of those northwest areas, but you're not in prime location, so your capital growth is going to be less. There's always trade-offs, there's always balances to be made when you're making these types of decisions. But yeah, these are the decisions that you need to make. So the first one to recap is like, what is the strategy? Is it buy to let HMO, government-backed contracts? Is it professional tenant, student tenant? What is the product market fit? What is your own goal? What goals and parameters have you set for yourself? Is it 10% acceptable for you for return, or do you need to get 20% because you want to drive cash flow? How much cash reserves do you have, and what goal and net cash flow do you want to achieve in a certain period of time? Once you understand that and you understand the model, then you can find the area that's right for you. And you may decide that, hey, I want to invest in area where I live just because that makes sense to me, and maybe you take a lower return, or you decide that, hey, you know what, the number one most important thing for me is that I can scale my portfolio out over the years as quickly as I can, because potentially I'm not doing something in life right now that I fulfill, and there's this pressing pain or need to get out of a job that you don't enjoy. And that was me like a long time ago now. I was in that situation, right? And therefore that's one of the reasons why I chose the Northwest and went to drive cash flow and wasn't worried about capital growth. And now my position's changed. I'm a business owner, make great profits, really grateful for that. I can replenish cash flow. If I leave 100k in a deal, it no longer bothers me. The cash flow will be replenished within 4 weeks from the business activities across my group of companies, and therefore I can invest in high growth areas with prime location like Oxford, because I can afford to tie up more cash. So hopefully that helps make your decision on where you would invest and gets you thinking about the best places to invest, right? If you enjoyed this video, please, like I say, click the like button, and in the comments section, let me know where you're investing and why. I'd really be interested to know what strategy you're deploying where and why that worked for you. And also make sure you hit the subscribe button if you haven't already, and ring that notifications bell so you can be notified when we bring out new content. And if you want help finding an area that's right for you, in our training program, Property Investors Accelerator, we have systems. We pull in data from Rightmove. We also look at property data from the software sites like Property Data as well. We pull in data from Rightmove. We look at property data. We analyze the data. We show you have an exact blueprint of how to go out and find and basically take this high level information that I'm giving you, distill it into granular information that makes sense to you, so then you can go and apply the theory that I'm talking about in this video on a much more individual, personal level to you, so that you can go and achieve the goals that you want for the property portfolio that you're trying to build. And if you're interested in doing that, there's a link below. You can book in a call with my team. We are open for applications right now, and we'll give you all the systems so that you can pull it in from Rightmove. And like I say, follow our proven process that's enabled us to scale out to multiple millions across a portfolio, and establish great cash flow with that as well, for individual parameters, for individual people, based on their parameters and our own parameters, and what I've done for myself. So with that said, and without further ado, I'll wrap this one up, and I'll see you in the next one. Speak soon.